Welcome out to Trading Justice 597. I'm joined with my brother Matt. This is Mark Justice from Tackle Trading. Big week in the markets, historic Fed cut. All of those whispers ended up being true that we talked about last week. We're going to break it down. We're going to have a discussion on what it means, what we're looking for. A little, as my brother entitled it, "When Hawks Cry." A little homage to my favorite singer of all time. The great purple one. How you doing, Matt?
Doing good, and you were absolutely right. I was thinking about Prince, but honestly, when Doves Cry was such a fantastic song, but I kind of feel like the monetary hawks are the ones crying right now.
Yeah. Well, listen, I cried when Prince passed away. I did. I was a huge Prince fan. Just the guy just was so talented. But listen, Nick Timmeros, pretty talented at getting the inside scoop at the Fed meeting, right? Like, the setup coming into this meeting was, all right, 25 basis points based on, recent inflationary data and recent Fed speak. And then Nick Timmeros wrote those two articles, basically preparing the market for a 50 basis point cut, laying out the case in not one, but two articles. And so when Wednesday came, right, nobody was shocked. Even those that were like, oh, I thought maybe nobody was shocked because the Fed prepped the market that was coming. That was your initial reaction when the Fed cut 50.
Well, the probability had shifted pretty aggressively over the couple days coming into the central bank. So my expectation a couple weeks ago was a 0.25 cut, because that's kind of where the economic data, that's where the inflationary data, it made sense for a 0.25 cut. But the probability certainly had shifted coming into the Fed for that 0.50 cut. So you're absolutely right. The Powell, through Nick Timmeros and obviously the Wall Street Journal, certainly did prepare the market for what was going to transpire on Wednesday of this week. But even at that, I still feel like I'm a little bit surprised at not only the 0.50, but more quite frankly, more the guidance that was updated as well, where they were doing they're expecting another 0.50 through the end of the year. They're expecting another full point next year, followed by another 0.5 cut as they start, kind of winding down the restrictive territory of the interest rate. And so their projections for the next 2 years is basically coming down to around 2.75 to 3% interest rate. And I kind of felt they were going to kind of stop that right around that 3 to 3.5% range, just given the fact that that's still slightly restrictive at 3.5%. And I do still have some concern on the core side of the equation. And so I personally, I don't think anybody was surprised this week, because again, Nick Timmeros and the Wall Street Journal through Jay Powell and the Fed certainly informed the market. But to me, this conversation is not concerning today. But the question I have in the back of my mind as a fiscal monetary conservative, I'm fiscally conservative, I'm monetarily conservative, and certainly I'm a little bit of that hawk. And maybe I was talking about myself crying a little bit on the inflationary side when I named the podcast "When Hawks Cry." But
Michelle Bowman,
I do have some concern on the core side of inflation, that if the Fed gets too aggressive in this situation and the economy doesn't spiral, I think we could see a repeat as we come into January, February, March of this year, to the same way we came into last January, February, March, where we started seeing that double dip inflationary impact. And so the Fed seems very committed right now to on the path of policy. I don't question the path of policy. It's pretty solidified right now. 0.50 cut expected throughout the rest of the year, another percent the year after. There's a lot of clarification on the path of policy, but that doesn't mean there isn't some degree of concern that the Fed is making a policy mistake here. And that's where I feel like we can have a little bit of an interesting conversation and an interesting debate, given the fact that, quite frankly, nobody was surprised at the 0.50 cut, but I still think there is some concern down the road a little bit regarding this, how aggressive they are getting on the cutting cycle.
Yeah, I know. I mean, and it's one of those things that nobody's paying attention to inflation today. But it can become a story, right? If it is built upon those last data points, right? If you see inflation uptick one time, it's just something you note, right? You
Yeah.
see it uptick two times, all of a sudden you're like,
Well,
you know, and then if you see it three times, you're like, well, all of a sudden you have a story.
listen, to me, the three is when the Fed gets concerned. I get concerned on two data points, but yeah, on the cutting side of the equation, where's your head on it? What do you feel like the Fed is on the right path here? Do you feel they're what's your read on the Fed and the interest rate?
Yeah, like I guess right now it is a practical one. I'm in the camp that China is eventually going to launch a huge, massive stimulus thing, which is going to feed into inflation. I'm
Mhm.
in the recession isn't coming camp. You know, which means, I mean, when you look at the economic data, you have a healthy economy, you start lowering that interest rate, that's going to feed into that potentially. And so it's one of those, I understand why they wanted to start the cutting cycle,
Mhm.
right? I understand why they wanted to do that, right? Like, you know, because there are worries, but there aren't things that, you know, but there are also worries on, you know, on the labor market. So I
That
get that,
worry works both ways.
you know,
When you have a dual mandate, you got to kind
and
of.
so I get it. You know, I understand. You know, but I certainly am keeping more than one eye on, you know, there's a couple tiers for me on this. One, what happens in the market right now, right? Like what happens in the market in the coming 3 to 6 months with economic data, and we're going to talk about that in a second. It was something in the Tackle Trading newsletter that you spent a lot of time on in recent weeks. And then what happens in that next wave, right?
Mhm.
You know, and so like that next, you know, so what's the tactical implications today? We're going to break that down from a
You
technical
got short
perspective.
term and long term, right? Short term, like my concern over whether or not the Fed's making a policy mistake right now does not change the way I see the market in the short term, because the market in the short term is going to celebrate this, and rightly so, right? If the economy's cooking at 3% and inflation's at 2.5%, and we just entered into a rate cutting cycle, if the economy stays strong, this market's going to stay strong. Period. End of sentence. So in the
Yeah, and I want to discuss that tackle trading news. It's a fantastic reason to become a pro member. We do a really good job with that tackle trading newsletter. You know, basically capturing everything that's happening in the market from a
Mhm.
technical, from a big picture, from a sector perspective. Look at rotation. That's going to be something we talk about here in a second. But a few weeks ago, you laid out the historical evidence, right? That, you know, and I saw Michael Hartnett put a note out, and I love Michael Hart from Bank of America. He put out a note this week, and I'm like, yeah, my bro was on that a few weeks ago.
We're usually in front of some of those
and
macro conversations, quite frankly.
it's like, all right, so the rate cutting cycle, yay, but what does it mean? And it's entirely how the economy does, right? If you start a rate cutting cycle, and you laid it out. You're like, gold does great no matter what. We'll talk about gold here in a second. But risk assets, equities, right? It is not as simple as rate cuts, yay, YOLO, those, out of the
It
money call
always
options.
goes to the what is the logical reasoning of the cutting cycle? Are they cutting for economic pain? Are they cutting because they feel like they've declared victory on inflation and they got good control of the inflationary situation? That is not a, you don't know the answer to that question right now. Nobody in the world can tell me exactly how the market is going to respond to a variety of different variables over the next 3 to 6 months as we're going through this rate cutting cycle. Because if there is some weakness in the economy and we start seeing that weakness play out from an economic data perspective over the next 3 to 6 months, Mark, we're not going to be continuing a bullish uptrend with economic reports that are showing a contraction economy, with the Fed being lowering interest rates. In those environments, the data is extremely, extremely clear. The market does not settle down, meaning it doesn't stabilize until the Fed is done with their cutting cycle. And so if this turns into an economic conversation where we start seeing economic weakness, we start seeing a little bit of labor give up a little bit more than it has, We start to see manufacturing data go into recessionary territory. We start to see GDP start to contract. And again, none of this is a short-term conversation. This is a 3 to 6 month conversation. But in that conversation, if we are in a rate cutting cycle and the conversation becomes one about the concern about the economy, the market does not stop selling until the end of the cutting cycle, when the market knows at that point this is the lowest interest rate you're going to get for the next cycle, and at that point it starts to stabilize. If the market does not have that economic conversation, but the rationale of the cutting cycle is simply to alleviate the restrictive territory of the interest rate in comparison to where current inflation is. Current inflation on the CPI is right around 2.5%. Right now, you got core's a little bit higher than that, but around 2.5%. You have the Fed fund now at 4.75 to 5%. You still got 2.5 basis points where you're still in restrictive territory. And so if you're cutting because you feel you have a handle on inflation, well, then the economy can actually do really, really, really well in that environment. And so it's not as simple as just saying, oh, we got rate cuts, let's party like it's 1999. I will say this.
Look at that, the second Prince.
I got all Prince on me today. But I will say this. Governor Waller came out on Friday and gave a speech on Friday. And when he was asked why he chose to do the 0.5 cut instead of the 0.25, it basically the argument that he laid out was the inflationary side, that he felt that they had done enough on the inflationary side, and he was comfortable enough on the inflationary side that they could alleviate that restrictive territory. And so if that is the general message, and if that is what actually plays out, long-term, the market can do it really, really, really well. However, it is not something that we know today.
Yeah,
to understand the economic environment over the next.
I call these things narratives, right? When I'm speaking, to students or a thing, the language I use are narratives, right? Like, what is the narrative in the market? And the economic one is a little unsettled. It's like, are we having slowing growth? Are things expanding? That narrative is in flux right now. It has not been decided. There is people that have opinions on it, right? I have an opinion on it. I'm sure you have an opinion on it. People have opinions on it, but you don't have to go way back in market history. You just have to go the last couple months to see little bouts where economic data came in on the soft side and the markets did not like that.
Listen,
right?
I personally believe, just my base case is that we do achieve a soft landing. That is my base case.
That's where I'm at as well. Government spending too much money.
But that's not a high probability. There is, say it's a 70% probability of a soft landing, a 10% probability of a growth environment and a 20% probability of a recessionary environment. I'm making up numbers, but again,
you're just sure.
General areas there. So I do think the base case is that the market is able to withstand a rate cutting cycle, because what we're seeing out of Waller, and quite frankly, the labor market, although it's been giving up a little bit, it has not cratered like many people expected it to. Labor market actually had a pretty good initial claims report this week. And so that long-term conversation is always going to be in the back of my head as we do navigate the economic conditions over the next 3 to 6 months. But again, there is a massive difference in short-term versus long-term on this conversation. Long-term, we got variables to talk about. We got to be aware of these types of conversations, but it's not a day trade. It's not a swing trade. It's not a position trade. It's long-term right now. On the short-term, with the expectation of the cuts, Governor Waller confirming that the cuts are basically on the inflationary side, thus alleviating the restrictive territory. All I see is a breakout with the snapback.
And that's the practical trader in both of us, right? It is like, all right, we're going to keep, we're macro guys, right? Like we will be paying attention to the narratives and the economic data that forms, right?
And if you want to, if you're just finding us for the first time, I promise you, we will be talking about those conditions as we do navigate
And it is
it.
those. It is
And
those.
we're usually about a month in front of the rest of the world in those
We
conversations.
are, and sometimes like gold, we're more than a month in front of those conversations, right? And so we keep an eye on those macro, larger stories that develop.
Like
For
hawks,
example,
bro. Like
yeah,
hawks.
like if, for example, let's say you break a support level and you have a really bad macro narrative. We'll treat that much differently than if you just break a support level, which we'll respect to begin with, right?
Mhm.
But in the short term, right, my general thoughts coming out of Fed is bulls got it's theirs to lose the game, right?
I,
Like
I absolutely agree with that, Mark. I mean,
like that's how it just is. Like it's the bulls to lose here. You know, you have
and let's talk about this from a technical perspective, because I do think that is the best way to navigate the current conditions. I've felt that for a while. We've been navigating this pattern in the general market for a good 2 months in the market. Remember, we just broke out of a level that we had actually achieved 2 months ago. Over the last 2 months, we had a pretty sizable pullback in the market from 565 down to 510. And then in September, the beginning of September, you remember that September seasonality, 2 days we had at the beginning of September. Well, that was at a resistance level, saw a sell off there. And in that newsletter that you were talking about, Mark, the way I described that was just a pullback, was just a bullish retracement that was coming into some standard Fibonacci numbers, and that we as a community should treat that as such. And that 540 level held really, really well. Because that 540 level held, as the market worked back up into 565.
And Matt, and I've given you this compliment in public in our pro community. I don't know if I've done it on the podcast. Your technical analysis on that, on what appeared to be a nasty break of short-term moving averages, it made me money. I did not get really defensive. You know, I looked,
on the violation of the 50-period moving average. I quite frankly, I felt like there was algorithms that were pushing it to the next support, algorithms pushing it to the next support, but the 20-period weekly moving average was a battle zone for the buyers. They stepped in and they obviously came through. Yeah. But the importance of that is it established a cup and handle formation, which allows every technician in the world, which is 90% of the entire market, quite frankly, because of algorithms, it allowed us to look at that through the bullish lens of continuation pattern analysis. And when you look at this from a multiple time frame perspective, you have a clean breakout of the 565 level on the daily chart. You have a snap back, which confirmed on Thursday. You had a gap down into that 565 level on Friday. You held that level on Friday. That is a secondary confirmation signal when you snap back and you hold the breakout channel. The daily chart does look like it looks like it's ready for a little bit of a bull run. On the weekly chart, this thing looks really, really good on the weekly chart. We confirmed the all-time high breakout. We closed around 568 with an upwick of around 572. But the breakout that it held on the daily chart and that gap down on Friday was significant because it allowed both the daily chart and the weekly chart to both confirm simultaneously in what we call a multiple time frame breakout in the S&P 500 on Friday and throughout the week this week. It's a good signal. Obviously, we upgraded the S&P 500 in our tackle trading newsletter. And what was interesting, and I think what's interesting to talk about now, Mark, if you want, is this isn't an entire market move here, because we are seeing some early.
So that's exactly where I was going to take
sector rotation, right? And so how do you want to handle this?
Well, yeah, because like the first thing I did, in my own accounts was like, all right, let's focus on credits on the easiest of them all, the Qs, SPY, because cash flow trader, because I'm not going to be able to figure out with precision where does the market really love post Fed. I can have some speculation. I'm pretty sure it's going to favor some areas over the other, but like putting this in the bulls camp, like I'm like, all right, launch a round of conservative credits on the easy stuff, the SPY, the Qs, right? The market itself. So wherever the market goes, well, I'm going to catch the market. But now, like many traders, and this is something we do with particular great emphasis and skill at tackle trading, is, identify where money is rotating into. It's been rotating into defensive sectors for several weeks, right? We see that on the
months, not
chart.
weeks, months.
Yeah, months. We see that on the trends. We see that on the charts, right? Growth scare, defensive sectors get a bid. News at 11. That stuff happens every freaking time. Market has a macro moment. And that's how the market is actually going through a little macro moment on growth, because defensive got bid really strong.
Well,
right?
and here's the thing, though. When you look at this from a 1 to 2 day situation, right? It's easy just to say, oh yeah, aggressive's having a moment and defensive is taking a back seat. And that is absolutely correct. That's absolutely transpiring here. When you look at the last week in the marketplace, and when you look at a heat map, for example, where do we see the oversized green areas of the market? You see them in Max 7 components, sans NVIDIA had a little bit of a 2% pullback last week, but you see overpriced size movements in cyclical as well as aggressive. And so
I think it stands out. JP Morgan, higher move than Apple. GE, which has been a cyclical darling for traders for a
industrials
long
had
time.
a great week.
Some of the bigger industrial names, bigger moves than Amazon, bigger moves.
Industrial and utilities are our two highest rated sectors right now. By the way, I don't categorize utilities as much of a defensive sector right now because
it's its own thing.
It's the AI tech build out. It's not its own. It is the AI tech build out.
Well, I mean, in defensive sectors, yeah.
No, what I'm suggesting is, and I've talked about this in this podcast, I've done multiple different AI webinars. AI is one of those things that I have a little bit of an understanding on. It is that secondary impact we're starting to see in unique sectors through this AI build out. Utilities is one of, like, for example, when utilities started trending along with the AI trade, a lot of people were like, oh my goodness, why is this happening? Why is this happening? It's happening because the mega cap tech companies, they can't go to the general market to get their energy needs to power all of their data centers, which means they are literally privatizing some of the energy space to ensure that they do have the necessary energy to power all of their data centers. And so utilities takes on a little bit of a different feel outside of some of the traditional defensive sectors right now. But when you do look at a heat map, you can clearly see industrials, energy, basic materials, technology, communications, consumer cyclical, all aggressive, i.e., or cyclical areas of the market doing really, really, really well. Well, where's the reddest areas on this chart this week? Consumer defensive, real estate, healthcare, and some of the utility areas, as defensive did take a little bit of a back seat. But my point on that, Mark, is I don't feel we're just seeing a sector rotation based on a new catalyst in the market. I have a feeling that this was already going to transpire, even if it wasn't for that catalyst. And the reason I say that is when you do look at real estate, I don't care how you describe it, but you have to describe it as late short-term trend. You have to describe this area of the market that has been going up for 3 consecutive months in a momentum trend that is starting to show increasing volatility and slowing momentum at the top of the trend. You got to say that's late stage trend. When you look at healthcare, for example, healthcare has a double top. Now you're looking at a continuation pattern. That's obviously the end of the previous trend. Now you would be looking at a secondary setup through continuation pattern analysis. When you look at consumer staples, the same thing you're seeing in healthcare, maybe not the clean double top, but you do have slowing momentum. You're giving up the 9 EMA, the 20 SMA. And so you are seeing defensive areas start to slow down. My point is they were already in late stage trend. Where has things not been trending recently? Technology. Where has things not been trending recently? Communications. Where has things not been trending recently? Well, that's discretionary. And so you're now starting to see the beginning point, and this is going to be really fascinating to track this week. I find this week to be an extremely compelling technical backdrop week, because if we see the continuation of what we saw early in the post-Fed rotation, there's going to be some really good opportunities in aggressive. There's going to be great secondary patterns happening in cyclical, and we're just going to have to tap on the brakes and take a little bit of a break on the defensive side of the equation and let those defensive areas just kind of do what they're doing in the short term. And so I find this week to be really compelling. Do we get a secondary pattern on discretionary that's overextended going into the breakout? Do we see communications finally hold above that 88 level with some momentum? Do we see technology form a secondary pattern at quite frankly the 226 level, 226, 227 level? You could see some very compelling setups happen throughout this week, because I'll tell you, me and Frank did our broad-based scanning on Friday for the traders report, and what we had noticed is that we're seeing the early signs of something in technology. We're seeing the early signs of something in the aggressives, but because of the volatility has been wide range, they're still dirty charts. They haven't got clean yet. The market has an opportunity to get clean this week, and that would be a really compelling situation as we do navigate this week.
Yeah, a couple of things I'm looking for on economic data, because I think, and we pull up Forex Factory, as we look at the coming economic week, and look at the Johnny on the spot there, right? You ready to go play quarterback for the Dolphins this weekend?
I might have to.
My brother Matt's going to the Dolphins game.
Yeah, I might have
to. But
dude, I'm gonna tell you right now, I still chuck that football 55 yards downfield, so we might have to line it up.
All right. So there are a couple of things I'm looking for, because we're still going to be in this economic data is, sensitive to economic data that we've been for several months now.
Mm-hmm.
I mean, there are time periods in the market where the market doesn't do anything on economic reports. And then there are time periods where it's been ultra sensitive. We're going through one of those. A couple of things I'm looking for, right? Because along the way, you're going to get a bad economic data point, right? Now a bad economic data point, you probably have a, defensives, the defensive if you get bid, cyclical sell. What I am looking for, though, one, the general trend, but that's more of a week to week, month to month, what's the narrative building? I'm looking for a negative economic data report where the market doesn't sell, because we have not seen that in a long time, right? Like where something comes in, it's negative and the market doesn't sell. And then I'm looking for an economic data point where maybe the market sells a little bit, but an area of the market does not sell, i.e. tech, right? Because you've had bad economic data points at points, over the last few months. Tech sold, cyclical sold.
You're looking for that ASO analysis that we
I am looking for,
2 weeks ago on an economic event.
I am on an economic event where
you're like, the market should have sold that, but it's up a point.
The market should have sold that. Like buy the textbook. Think about it. These are such, you want to know the day that the bear market ended in 2022? It ended on a ridiculously hot inflationary report
that tried to break
that tried to break support.
Snap back.
That the market bought.
I remember that.
The market bought.
I remember I remember that, and I'll remember that a long time, Mark, because I felt like I was the only guy in the world defending the market at that point, being like, this is a buying opportunity. We are not going through a deep recession. It's going to soft land. This is a buying opportunity, but that's not the conversation anybody wanted to have in 2022. But the minute that happened that you described, where you saw that gap down, fire back up off that violation of
the bear market was over.
Everybody got back on the bullish freight train.
The bear market was over.
Yeah.
Like the bear, and when you look at ASO, and we've seen this a few times this year in different stocks. We saw it with McDonald's. If last earnings season, if you had a bad earnings report, you got torched. We were doing the lounge. McDonald's came out, had a bad earnings report, got bought up. Look where McDonald's is since then, right? We saw this on ASO, something that we highlighted.
By the way, ASO's
bad
up
report
20% since that moment, Mark. 20%.
Got bad report by the numbers, should have sold, didn't. These are huge tells. Now
Keep
on individual companies,
ASO's retracement. I'm just throwing it out there. It's got a really good retracement setting up on ASO.
When these events happen on an individual stock, they can put you in a position for some nice trades. When they happen on the market, they lead to you outperforming the market because you're reading what happens. And so I'm on the lookout for that, particularly tech, where like maybe you get a bad economic report, something that where you're like, oh yeah, the market should sell this, and tech says no. ARC says no. High growth says no. We're not. We're going to be trading on rates from now on, not.
I certainly agree with you. Those are really compelling data points. When you see a data point come into the market, and the market should sell that based on the current behavior of the market, and the market doesn't, it really stands out to you. That ASO stood out to you and I in a moment's notice, because both of us, okay, that should have sold. They lowered guidance.
That was a terrible report. They lowered guidance, and they're getting
they missed everything, Mark. They missed everything. It was a terrible report, and it came from the week before, where
and you learn, Matt, as a trader, you learn like
these telltale signs.
It's not as simple. Yeah, it's not as simple as, well, that's a bad report. You're like, oh, that's a bad report.
Big role
and you trust the price action. You trust the price action.
Is there an economic data point this week that you see as more important than others?
I think it starts off right off the bat. Monday mornings,
you think
15 minutes after. I think that's the report of the week.
You think manufacturing PMI specifically?
No, I think it's services because of the larger, but I think it's the combined.
Right? Like, the PMI numbers. PMI numbers become chiefly important in an economic conversation.
Yeah,
they were not part of this conversation for the last 3 years. PMI numbers,
like nobody cared.
Nobody cared about PMI numbers. Manufacturing PMI mark has been in contraction territory for the better part of the last year and a half. Nobody has cared because that hasn't been the conversation. Because when you're going through a rate hiking stage and a pausing stage, the market will behave differently in those environments versus when you're going through a rate cutting stage. These PMI numbers, they become chiefly important as we start navigating more of the economic conversation. And Mark, I think that's the most important report of the week as well. Even when you do have consumer confidence on Tuesday, final GDP on Thursday, and core PCE on Friday. First of all, final GDP is the third in a series. That's not going to have too much volatility to it. I think Chairman Powell on Thursday is going to, anytime Powell speaks.
It's pre-recorded announcement. It's not live. It's pre-recorded. It's at the I looked into this one. It's at the Treasury event, and he's
those remarks will be already embedded into the market. So I agree with you. I think it is the PMI numbers on Thursday itself. What are your thoughts on the commodity space here, Chucky? Because there's obviously a debate that we're going to have, or a road we're going to have to traverse long term on the economic side. But what about the commodities here, Chucky? What did you hear out of Powell regarding gold, silver, copper, the commodity space?
I can make a case for just about everything. Gold, I don't like, we know our fundamental drivers. The case is a technical one there for me though, right? Like, oh, you broke out on a really clean control pattern after having, 5 or 6 weeks of really controlled price action. That has preceded that was 5-6 months of really controlled price action, right? Like, until that story
really
changes,
astonishing to not see any volatility.
Until that story changes, right? We have a fundamental case. We know what it is, right? Like, but until that story changes, you keep looking for opportunities.
I'm just gonna say it like this: every day that goes by, there's a scenario where that's never a price you'll ever see on gold.
Seriously, that's a true statement, bro. And so, I'll do some that. Now, will I do it in gold or will I do it in silver? Because I do buy the silver general catch-up story, right? When you look back at history, right? When you've had larger moves in gold, silver has tagged along. Are we in the midst of a larger move of gold? Probably, right? Like, much larger when you look back and you look back at the
cutting cycles are really, really good for gold. And technically right now, gold looks great. And the environment on gold has never been a better environment.
I'm also like silver for lots of other reasons, right? Like, there's other things. I also do not think I have very simple logic, like, as long as the government is spending as much money as it is, we're not going into recession. It spends like we're in a wartime. It's spends like we're in COVID every year. Right?
Have they lowered the budget since COVID?
No,
Is there any
we're still in
anticipation
crisis spending.
hold on. Is there any anticipation or conversation or discussion or any proposal on lowering? I mean, we're having a debt ceiling conversation right now. They're going to they're going to hypothetically shut down the government, but it has absolutely nothing to do with fiscal responsibility.
Yeah, and so Trump wins, Harris wins. They're going to spend money. We know this.
If there's one thing I am absolute certain on, whoever the next president is going to spend more money than the previous president.
And so I like silver for a little bit of the catch up. You go to copper. This is a beautiful technical story. Give me that copper chart, right? You had chances to sell off. You bottomed. You fought for it. You earned it. The classic bottoming pattern style. One that lasted for an extended period of time. You earned that price action. I still am in the camp of
which one would you take if you had to take copper or silver? Which one would you take?
Well, I would take the shore silver, because
I would too. I would too. I think don't get me wrong. I really like the reversal happening on copper, and if we get some proper development on FCX right around that top shelf billing, which is a really important 46 handle, I might change my tune if we get a really clean situation on FCX right around 46. However, when you are looking at silver here, Mark, I've been around silver and gold for a while. And if gold's going to have a run and commodities in general have a run, silver does play catch up in those.
Yeah, make no mistake. We were talking rotation. Mm-hmm. One of the areas that might be rotation winners are commodities.
They were the cyclical areas of the market were the two biggest winners.
You think it's like oil had one of its best weeks in forever?
Energy.
You think that's just random? No, it's not.
Energy, right? Oil, industrials, finance, BMATs, all of them have been clear winners in the 2 days following the Fed.
Got a couple of. Give me URA, uranium. Not something that we cover every day, but it's not every day that 3 Mile Island starts back up. And you alluded to this earlier in the podcast. And Microsoft announces that they are buying all of the nuclear power.
Now they're only opening up, I think, one reactor, and it was.
But it's the Microsoft reactor.
It is the Microsoft. They will put Microsoft reactor on that. No doubt about that. But
that's a genuine catalyst. That's like a big, huge, massive story, right?
And this has been going on. This has already been going on for the last year. We've seen energy companies get privatized through the tech space. OpenAI is building their own nuclear power plant in Washington. So this is happening, but it had not happened on such a grand scale up until Microsoft. And now everybody understands what is happening there, not just, AI geeks.
Yeah. So I'll do some play on uranium this week.
Are you liking uranium here? You think
I've been a uranium bull. I haven't been as active in the last year as I was coming off of COVID. The uranium thesis is so strong. But I think you get reignited here. I think you absolutely pay, from a credit perspective, lobbying naked puts, that thing's easy right
directional. Now. You got wide range volatility and
pay attention. Watch those secondary patterns. Right.
If we form one around the 200-day moving average, that would be beautiful because that's got every moving average right there.
Yeah, and so
legitimately. So I don't have a directional opinion on uranium, but I would at 28.5.
Let's go a couple other Bitcoin. The one thing I don't like about Bitcoin is that it's trading with risk assets right now. I don't like it when Bitcoin does that. I'll just trade risk assets. I'll go if it's going to trade with the Qs, I'll just take the Qs.
If you're going to trade with semiconductors, I'd take semiconductors.
I just take semiconductor. Right? I mean, if you, IBIT got options, bro.
Huh? What?
I heard a rumor on Friday night that IBIT got options.
Are you serious?
SEC approved.
I see no options.
Because it got approved after the hours on Friday.
You're telling me it only took them 10 months?
That was a cash flow Viking who leaked that rumor to me because they know how much I've complained about that.
It will change the way we look at IBIT. I'll tell you that.
It will make That is a
We have
massive
rules.
story.
We have rules that tackle. We don't invest in things that you don't have options
We
on.
have not had a great option instrument. We've had Bitco, whose options are like B level, right? Like they exist.
I won't even touch Bitto.
But they're nasty. We have like Bitcoin miners, right? You know, you got Coinbase. You know, you got but
Coinbase is impossible to trade based on Bitcoin, though.
Exactly, right? Like exactly. So we have not had a great option instrument for Bitcoin. We do now, if these rumors are true.
Well, it only, like I said, like it's a travesty, and we should have an investigation of why we don't have options on IBIT as of right now.
Because Gary Gensler hates crypto. There's your investigation. There's your investigation.
Gensler hates crypto. That is accurate. And it will be really, really, really nice to have Gensler no longer be the SEC chairperson when that eventually does occur.
Yeah, and the only thing I can't make a case for heading into the weekend is crude oil, because the technical situation is about the worst you can possibly have. I actually added crude oil on the way down when it got oversold and hedge funds were dumping. But man, it's in a nasty spot to enter the week, in the sense that you V'd up, you're into falling moving averages, you formed no support levels on the way on a volatile instrument.
It's V-shape everywhere, every day, on every time frame, and it's annoying and exhausting. And until that changes, I don't have an opinion on crude.
Yeah, so it's not a bad backdrop for commodities, right? Like, and looking at them. And so, like, that's something that, we, in our community, put an emphasis on. And there are environments that are pretty decent for commodities. And this feels like it's one of them, right? It feels like one of them. It feels like you're going to have to reignite the recessionary. But even if you do, gold's still going to do good. Uranium don't care about that. Silver might tag along with gold anyways, right? Mm-hmm. So not a bad thing. Just give me that dollar chart real quick, because if this support level doesn't break, Matt, I think if we look back at this support level and it hasn't broke, that's because economic data never got too bad. Like, I don't know if it's more complicated than that. Like, could it break without bad economic data? That's my question to my currency loving brother.
Could it break without bad economic data? No. If it was going to do that, it would have broke on the dovish tilt coming out of the central bank, and it would have broke. No, it's got to break on negative economic data, which means the dollar could trade closer to the S&P than we're typically comfortable with.
Yeah. So I
shouldn't say like that. Typically, like, usually the dollar is opposite the market. The market and gold run a little bit more in tandem than anything. I still see the dollar and gold, being that divergent asset class. But if we're going to, and I'm going to have to go do a little bit of study on this question, so please don't take this as the Lord's word here, because again, I need to go do some research. I'm just thinking out loud. But in a rate cutting cycle, if we're going to embrace the economic conversation, then the SPY and the dollar logically would trend a little bit more in tandem during that cycle than in other areas of the cycle. But again, that's just off the top of my head. I'm going to have to go in and do a little bit of homework on that one.
Yeah, no. And so in this podcast, we wanted to talk about the Fed. We wanted to discuss this big event, but then spend most of our time on what's the practical things to be looking for. Obviously, market strength, right? Technicals, so maybe some things with economic reports, but really focus in on those rotational. Where are the patterns setting up? Where are the areas of the market that are getting a bid? Because that's what we do as traders, right? It's not, as we're looking.
I just think the market was running on the same gasoline coming into the event.
A phrase you used, you were using that phrase so often as I was getting sick of it.
That's because it was, but I was getting sick of it as well. Believe me, I was.
Because everything was just trading the same.
Well, that's what happens when we have that pure macro conversation, right? There, you don't have an edge anywhere. Everything runs on the same gasoline. Sectors were running on the same gasoline. It was annoying. we're now starting to see separation. And I do think that's one of the more important conversations as we do navigate this week, is that do we see continued separation? But with that said, we'll be hanging out with our tackle trading community every single day during the Traders Lounge, which usually lasts for about an hour and a half every single day at Tackle Trading, as we basically break down everything in the market every single day with our community. We answer their questions, we look at their trades, we talk about trade management. It's about 45 minutes where me and another one of the tackle trading coaches will just be breaking down all the news, all the earnings reports, the market action. And then there's about 30 to 40 minutes where it's the community's time and it's their questions. A lot of times they'll have education questions. We'll spend time in front of our entire community answering those educational questions. We will spend time looking at their trade setups. We'll spend time talking about trade management. And that's the thing about the tackle trading community that is very, very unique against other trading platforms and educational platforms out there, is the coaches of tackle trading. You know what? It's not me that described it this way. I'll just say what some in our community describe it as: the hardest working coaches in the business at tackle trading. And so if you want to be a part of that, come over there to tackletrading.com, sign up for a free 15-day trial. You can check out the tackle newsletter, the traders report, obviously all of our shows we do with our pros, the courses that our pros have access to. And then if you are not a member of tackle trading and you're not a member of the pro, but you want to still stay updated, well, every single morning we put out the Tackle Today email and newsletter for our entire community. So with that said, I hope everybody has a wonderful, wonderful week. I hope they enjoyed the podcast here as well. And if you are watching it on YouTube or Twitter, make sure to give us a nice little like and share and tell somebody about it and help us spread the good word of tackle trading. With that said, Coach Mark, I'll let you have the final thought here.
Little red Corvette. Go listen to some Prince music. Have a great trading week, everyone. Have a great week.